In this video, I'm going to cover fixed cost variances using exercise 1646 as an example. This is a continuation of the same problem for your profit variance analysis and your variable cost variances. And I'll admit, this probably is something new to you. We typically, before this class, don't cover it as much in Intro to Managerial Accounting, and you'll see some differences in the approach compared to the variable manufacturing costs, but bear with me, they're fairly easy formulas to learn. Our first fixed cost variance that we're going to calculate is called a fixed overhead price variance. And so what we're going to do here is compare the actual fixed overhead cost, and that's going to be given to us in our income statement. And again, in the income statement, they drop the last three zeros. We'll want to add those back. Our actual fixed manufacturing overhead cost is $1,050,000, and we're going to compare that or subtract from that our budgeted overhead. And keep in mind, compared to variable cost, we don't have a difference in our master or flexible budget for our fixed overhead because we wouldn't expect it to vary based upon activity level. And also when I go back up here, I recall that the fixed overhead was budgeted at $10 per unit at the master budget level of activity, which was 100,000. So to get that back, again, master flexible budget would be the same. $10 per unit times 100,000 units is $1 million. $1 million minus the 1,050,000 is going to be 50,000. Now, I do have to stop and think about, is this favorable or unfavorable? It is going to be unfavorable. So it is going to follow that pattern we did for the variable cost variances. If it's a positive number, it's unfavorable. If it's a negative number, it's favorable. But again, just in case you flip around the numbers that you end up solving for in the formula, the explanation is the actual cost is higher than what we thought it was going to be. So that's going to be unfavorable. So a new one again for you is that the second variance we're going to calculate isn't called an efficiency or quantity variance like the other variable manufacturing components. It's going to be called the fixed overhead production volume variance. So here's some good news though. One of the components that's included within it is our budgeted fixed overhead, which we already calculated as $1 million. So that's one of the two pieces. But another piece of information that we need is applied fixed overhead. So how I'm going to get that particular number is I'm going to take my original per unit budgeted amount of $10 per unit, and this time multiply it times the actual activity level. Again, if you go back to the past problems, I know it doesn't state it here directly, that was 94,000 liters. So applied fixed overhead would be 940,000. So I'm going to take my $1 million original budgeted overhead, that's what I have here, minus my applied overhead of 940,000, and that is going to be 60,000. Again, I have to interpret, is that unfavorable or favorable? It's going to be unfavorable. So I also want to stress, with this one, I think it's harder to understand maybe why it's unfavorable or if it had been favorable. I also want to stress why we call it a volume variance. Basically, what we're saying here is, let's try to measure the impact of fixed overhead, what it ended up covering based upon our difference in sales activity level. We originally thought that we were going to sell 100,000 units. We only produced and sold 94,000. That's a bad thing. So all that fixed overhead that we had got spread over less units, and that's a bad thing. And so that's also driving it to be unfavorable.